The Fed isn't being reformed. It's being dismantled, and the blueprint has been hiding in plain sight. Trump's big beautiful bill, Basel III, and the rails that the IMF and the World Economic Forum already wrote about all point to the same destination. If you've been told this is just politics, you've been misled. The Fed was built to guard the dollar. Now it's the weak link. Each time Trump hints at sidelining its power, markets react instantly. The real move is his big beautiful bill, written to sideline the Fed and reset the system. The big beautiful bill isn't branding, it's a policy crowbar. Strip away the speeches and it reads like this: the White House wants to decide how the debt is handled and on what rails it sits. That's not theoretical. Trump once tossed off a line about paying the debt with a little crypto check. People laughed. In the context of this bill, it reads like a tell. You don't abolish the Fed if you can route around it with new plumbing and force policy through the balance sheet. Now look at the collateral pivot that makes this viable. Basel III tightened the game. Physical gold didn't stay a shiny talking point. It moved into the circle that matters. Central banks didn't tweet about it. They acted. They've been adding metal at a pace that doesn't match the press releases. You don't need a gold standard tomorrow for this to matter today. If regulators reward real collateral and penalize leverage, the cost of fiat only promises rises. That's why the old Fed toolkit feels duller every quarter. Now put the rails on top of that floor. The new language of money is ISO 2022. Say it slowly because the voiceover matters. It's the shared grammar that lets banks, markets, and blockchains talk to each other without breaking. While people argued online, Wall Street built tokenized treasuries, funds, and real-world assets in pilots now going live. This isn't a pitch deck. It's a rollout. And here's a receipt almost no one quotes on TV. The World Economic Forum and the IMF have published papers and toolkits that describe debt tokenization and list Ripple as a company, with XRP referenced as a bridge asset for interbank settlement in that architecture. You can already find debt and equity funds issued on the XRP ledger. The point isn't that one chain wins everything. It's that the rails that speak ISO 20022 and settle with finality are already in the literature, already in pilots, and already earning fees. Scale makes this a wealth transfer, not a tech story. The global debt stack is roughly $300 trillion. If even a slice migrates to tokenized rails, the winners are the platforms that carry the flow and the assets that back the flow. The losers are savers stuck in claims that are easiest to reprice when the switch flips. This isn't just a domestic plan. Rivals have said the quiet part out loud. A senior advisor close to Putin claimed the United States intends to push its debt on the stablecoins and then devalue. Call it a scheme or inevitability. Once liabilities sit on programmable rails, you can stretch timelines, change payment units, or pay in a token that didn't exist last year. That's how you turn $35 trillion into something survivable without using the word default. Here's where this flips from odd to dangerous. To dismantle an old referee, you don't pass a law called End the Federal. You make the Fed less central to the new plumbing. You lean on leadership and guidance. You raise the price of being a pure duration holder via term premium. And you make the alternatives work better. Markets do the demolition for you. Let's pin this down to 3 signals, order from most leading to most lagging, so you don't have to guess. Signal 1, political pressure and paperwork. If you see the administration push to muzzle governors, talk openly about replacing the chair, and drive the big beautiful bill forward. Watch how desks front-run the meeting. Long yields and volatility will tell you they expect the rules to bend. Signal 2, gold and collateral behavior. If central bank buying keeps climbing, bullion banks talk more about funding costs, and gold breaks higher while long treasury auctions tail. That hurts savers first because it happens in real terms, quietly, before it shows up in narratives. Signal 3, rails going live. If banks and asset managers announce pilots to become products, tokenized treasuries settle against tokenized cash, and funds issue real debt on the XRP ledger, while you hear ISO 20022 from different institutions in the same week, the debate is over. The rails are on. Now the timeline. Stage 1 is talk. Bills get names, personnel fights hit mainstream, headlines pretend it's politics. Stage 2 is plumbing. Auctions wobble, the term premium rises, gold stops trading like jewelry and starts trading like insurance. Stage 3 is rails. Pilots become products, digital settlement gets clients, stage 4 is transfer. Long claims prove flexible, rail-aligned assets get repriced higher, and anyone holding yesterday's promises learns the new rules after the fact. You don't need a PhD to navigate this. You need an if-then map. If leadership fights escalate and the big beautiful bill advances, then shorten your interest rate exposure. And if gold surges while auctions stumble and funding chatter gets louder, then assume collateral is tightening and cut leverage tied to cheap duration. If tokenization headlines shift from pilots to products and you hear ISO 2022 in the same cycle, then don't sit in instruments that can be repriced by memo. Here's the midpoint reset to keep you from drifting. The asset that looks safest on your screen can be the one bleeding you in silence. Cash in a low-yield account feels calm until inflation hums for 2 years. Long bonds feel responsible until a single auction widens the term premium and your safe line item drops. Meanwhile, scarce productive assets with modest debt often hold value better than paper tied to a policy paragraph. Let's stitch one case snippet so you can spot it in the wild. Wednesday, the 7-year auction tails and primary dealers take more than usual. And a custodial webinar says ISO 2022 3 times in 15 minutes. If those 3 hit inside 2 weeks, you don't need a press conference to confirm the plan. The plan is in motion. There's one exception that changes the rhythm but not the destination. If growth lurches lower and unemployment ticks up fast, the market grabs duration as a reflex. Don't confuse that with a canceled plan. The rails still arrive, they just show up wearing a different narrative. So what do you do if you're not a full-time trader? First, shorten rate sensitivity. Favor shorter duration over long claims. Second, add a sleeve of explicit inflation protection you're willing to hold to headlines. Third, align a slice of risk with rails that are signing real clients and speaking ISO 2022 in public materials. Fourth, map your repricing dates now. Know when debts reset, leases escalate, and suppliers pass through costs. Do the boring moves today so you're not a forced seller later. Here's the part that turns a scary story into a clear map. This isn't prophecy. It's a puzzle with a picture already on the box. Political pressure weakens the old referee. Basel rules and central banks elevate hard collateral. Digital rails standardize how value moves. In the largest pile of claims on Earth, debt starts migrating to a system where the issuer can stretch and reshape it without a vote. That's not a conspiracy. It's open source. It's happening, and it rewards people who move while others argue about definitions. If you want these signals decoded before the headlines admit what's happening, subscribe now so you don't miss the next move.